Hello, this is Dean Kernut, and welcome to the Alpha Exchange, where we explore topics in financial markets associated with managing risk, generating return, and the deployment of capital in the alternative investment industry. With a curious mind and keen desire to learn how things work, Robin Wigglesworth has always found the complexity of financial markets fascinating. Now the editor of the well-regarded Alphaville Markets blog, Robin has been with the Financial Times since 2008. And through this period, he's covered episodes of crisis in traditional markets and more recently within the cryptocurrency realm. Robin shares his perspectives on how vastly the terrain has shifted in the delivery of financial media, pointing to the emergence of Twitter as a source of important information. In Robin's words, journalism is best when it is heavily criticized. The balance of our conversation is about Robin's excellent book, Trillions, a deep dive into the history of index funds and the massive growth in passive investing. Through his work, we learn of the key developments and the key people whose contributions led to the juggernaut that is passive indexation today, laying out the early academic research that called into question the notion that active management consistently generated alpha. Robin walks through the initial inauspicious attempts to create vehicles that simply bought the market. With a view that the massive growth in passive investing is a very positive development, Robin reflects on some of the risks. In addition to the proliferation of questionable ETFs, he cites concentration among the money managers, among the index providers, and even among the proxy vote advisors as considerations to keep an eye on. I hope you enjoyed this episode of the Alpha Exchange, my conversation with Robin Wigglesworth. My guest today on the Alpha Exchange is Robin Wigglesworth. He is the editor of FT Alphaville and also the author of the recent book Trillions, a deep dive into the ETF industry and really the founding of indexation as a strategy. Robin, it's great to have you on the podcast today.
Well, thanks for inviting me, Dean. I'm really happy to be on it.
I'm excited to have this conversation. As I said, most of the guests are practitioners in the world of derivatives and risk management, but you've really done something interesting here, and I'm very excited to talk to you about your book, Trillions. Before we do that, it'd be great to learn a little bit more about you and your background in the business of financial journalism. So tell us how you got started in this practice, and we'll get the conversation going.
Yeah, it's not a practitioner, just a very enthusiastic observer. I graduated with a degree in international relations and master's in international relations and a degree in journalism and history, and actually kind of had fallen out of love with the idea of being a journalist. And I did consider going into finance. A few friends of mine had just started working at Goldman in London at the time, but it just sounded incredibly tedious. By chance, I saw a job ad for a financial journalist in Dubai, and I'd studied a lot of the Middle East through my degrees. And I thought, well, that sounds interesting. And I was supposed to go to the Norwegian army. I'm originally from Oslo, Norway, and we have conscription. And I was supposed to be a journalist in the Norwegian army. But I thought, well, actually, it sounds more fun to do something I know nothing about, like finance in the Middle East. I loved it. It was kind of the first cut is the deepest. I loved that I could talk to lots of really smart, interesting, but also dodgy people doing fascinating stuff or idiotic stuff in some cases as well. And I loved unpicking it and understanding it. And I got to be a war correspondent for the FT briefly, but broadly speaking, I've mostly covered economics and finance ever since.
When does that start, just in terms of the rough year and time period?
Oh, God, I think it was in 2005. So my first job was in Dubai for a small trade publication where I covered banking, but primarily I was sort of thrown in to be the deputy editor and then the editor of an Islamic finance magazine. So literally the first interview I ever did and the first article I ever wrote was about Islamic reinsurance, or ritakafel as it's called, which is as incredibly exotic as it sounds. But it was just fascinating. And then I went from that trade publication to covering economics, Nordic economics for Bloomberg, based in Oslo. But I always wanted to go back to the Middle East. And when I saw the FT, the Financial Times was hiring somebody for a Middle East correspondent job, I jumped at that and managed to get that. And I've been at the FT ever since. So I joined the FT in June 2008, just before, well, hell had already started breaking loose, as I was painfully aware of having come in Iceland. But then the whole collapse of Dubai after the fall of Lehman in the fall of 2008 was a pretty fascinating story to cover.
Well, that's really interesting. Your background from the northern part of Europe. And you mentioned Iceland. I'd love to explore a little bit just in terms of the coverage of the financial crisis. And it's, again, just interesting that you mentioned Iceland, because I'm just recalling back in as early as 2007, there were comments in trade publications, things like the Wall Street Journal and the Financial Times, I'm sure, covered this as well. And there was always this discussion of the krona as this currency that sort of went up and down in concert with the VIX. And so I took a look at this in late 07, and lo and behold, wow, this thing really does sell off when the VIX rises. It was one of these real carry currencies. And of course, little did we know how much of a carry trade Iceland had become. Tell us about the financial crisis, just from your perspective, the way in which you were covering it, the things that you started looking at. I'm sure as busy as it was for folks like Hank Paulson, it was a pretty unbelievable time for financial journalism. It was sort of a breathless time for months and months. Tell us a little bit about that from your perspective.
Well, I guess the advantage of being an observer rather than a participant means that I never threw up in a dustbin like Hank Paulson did. When I became a financial journalist first, I was aware that there was this massive boom in that the smartest friends of mine, no matter what they were doing, were mostly going into finance. Even if they had no interest or care about it, the money was so good and they were just hiring, frankly, anybody. So if you were really good or really smart, you had good grades, you might go to a Goldman Sachs or a Morgan Stanley, but somewhere in that ecosystem, you'd find your level, as it were. And they were just sucking up an enormous amount of people. It was when I started working at Bloomberg, and even though I was covering economics, Bloomberg's just a great place to observe a lot of these things playing out. And I spent a lot of time really learning the terminal. I still love the terminal to this day. And my biggest thing I miss from my time there at Bloomberg is not the free breakfast, but having my own Bloomberg terminal. But you can really start seeing some 2006 when I joined Bloomberg. I was talking to people, I was reading everything. I was just trying to consume everything I could to learn as much as possible, as quickly as possible. And already in 2006, there was lots of chatter about subprime, for example. By 2007, you could definitely kind of see some of the issues around, for example, the Icelandic krona. I mean, it was a massive, massive carry trade where you funded in yen and invested in high-yielding Icelandic krona. And of course, whenever there was risk off, people repatriated that or cut risk and sold it and bought yen. That just made me kind of look into it more. And there were a few really good credit analysts in Scandinavia who were really good and early on the financial crisis and how bad it would be. I did not fully grasp just how earth-shattering it would end up becoming, but thanks to them, I was not caught unaware by the disaster zone that was Iceland. And I was aware that some of this stuff was clogging up bank balance sheets. And I remember lots of talk around Bear Stearns. It'll fizzle out now. That was the peak. It's claimed its victim, its symbolic big victim. I remember knowing or hearing a lot from people smarter than me that no, actually, this sucker's got further to go. But it was fascinating. I mean, the main thing I learned from it is that finance and economics, the financial system is this massively complex ecosystem, and it's too complex for any person or even any organization to really get their arms around. And even really smart people can get high off their own supply. Really smart people do really well, they make lots of money, and they start thinking that they are even smarter than they really are, and they end up doing something heinously dumb. And you can see that play out in pretty much every major and minor crisis I've ever covered since then.
Yeah, it's interesting. Sometimes, as you, I think, suggest, being in it and being an expert on it, sometimes you lose sight of the big picture. And what's interesting is, for example, some of the folks that got the crisis really right, an example would be from The Big Short, a firm that's called Cornwell Capital. Wasn't referred to that in the movie The Big Short, but they really saw it. They were outsiders to the industry. You mentioned Paulson, and one of his initial areas of focus in trying to undo the crisis was this very poorly designed structure called the MLEC. I don't know if you remember this.
Yeah, vaguely.
The banks themselves were going to be the backstop for subprime. And of course, they wound up needing the backstop. So he missed that.
It's amazing. It's like if you tie two drunk people together, they don't seem to walk any better.
Exactly. Well, just walk us through, just in terms of how you were engaged in covering the crisis, did it lead you down any specific paths? There was so much to look at, whether it was regulatory, whether it was the derivatives front. What was the area of focus, if there was one, for you?
Well, I think in finance, you know this even better than I do. The amazing thing about finance is you're always learning something new. But this was very early in my sort of getting my arms around the concepts. I was covering Iceland. Like I was covering FX and rates in Scandinavia on top of economics and politics. And because I was new to it, I was just consuming as much research, as much financial news as humanly possible, talking to as many people as I could. And I do think it was an advantage maybe coming in 2006, 2007, almost from first principles. When I joined the FT in June 2008, I was very painfully aware that I thought things were going to go badly still, despite the summer was actually a pretty decent period. And I remember going to like Dubai was building the world's biggest, tallest tower. At the time, it was nearly finished. And I remember going literally, I think 2 days after Lehman went belly up, to interview their developer, Nakheel. And they were bragging about, yeah, screw Lehman. We're going to build an even bigger tower now. It's going to be over 1 kilometer tall. And you just realize these guys have no clue. They just didn't understand it, or they just didn't want to understand it. And lo and behold, Nakheel went bust. Dubai basically went bust and needed a bailout from Abu Dhabi. After that, my job kind of after the whole kind of the aftermath and the aftershocks of the financial crisis in the Middle East, I wasn't covering Wall Street per se. I was just covering the collateral damage around the world and in my little corner in the Middle East. After that, I was doing everything, covering the Arab Spring and human rights issues and social stuff in the Middle East. It's just a fascinating part of the world. And then I came back to London to cover markets and finance full time in 2012, and then it was very clearly it was the eurozone crisis. Greece had already had its first bailout, but everybody knew that wasn't the end of it. And that was, again, just a fascinating experience, seeing smart people who do try to do the right thing still screw things up. And they screwed up a lot for a long period of time there.
Yeah, that's a really interesting area to cover, the eurozone crisis. And as you mentioned, the policymakers wanted the right outcome. It was difficult for them to get there. Some of it was just the challenges of bringing so many constituents to the table for cooperation. Some of it was this maybe distrust of markets. Tell us a little bit about that period, and just in terms of the types of connections you were making in terms of gathering information and trying to report on it in a balanced way. What was that like?
I have to admit, maybe for me, it was scarier than the financial crisis had been, purely because by then I knew a little bit more. And I wasn't quite as green as I was in 2007, 2008. And I knew abstractly that that was scary as hell, and we came very close to potentially societal collapse. I had friends in the finance industry, especially I remember one friend of a friend, he filled his entire basement with canned goods because he was convinced it was going to become a barter economy. I never had that sort of visceral fear in '08. I was concerned and fearful, but kind of vaguely thought, we're just pumping money into everything, it'll probably be okay. Which was right, but not because I was particularly smart or prescient about it. With the Eurozone crisis, you could see why the collision of finance, economics, and politics, domestic politics and geopolitics, just created this really toxic environment where you could wake up and have an accidental default of a major French bank just because of something that everybody agreed could be averted and should be averted, but just they couldn't get everything lined up. It was just so complex. That was one of those times when I was quite genuinely fearful that the euro would collapse, the entire project would dissolve, and it would be an economic disaster piling on misery after what was already a fairly miserable financial crisis. And maybe just working in London by then, yes, it felt scary. The good thing is that my wife is a nurse. I'd come home and she worked in a hematology ward with some very sick patients. And I'd come home and complain about, oh my God, the French and the Germans can't agree, and the Greeks are doing this and the Italians are doing that. Oh my God, Berlusconi can't sort anything out. It's a disaster. And she was like, yeah, I had 2 patients die today. It's like, oh, okay, my day didn't seem quite so bad in comparison. So my wife kept me pretty sane over that period. As panicky as I was, I think that helped.
Yes, financial panic is a thing, but certainly what healthcare workers experience on a daily basis is entirely a different thing. You make these points around just the panic and the uncertainty, and that risk event sticks out for me as one of the most interesting one. And I like the way you framed it, which is just this collision of finance, economics, and policy making. And it's just really difficult. It was difficult to find the solution, and the price of risk really suggested at different times how elusive that was. So that's 10 years ago, and it feels like a lifetime ago in a lot of ways. One way is just the way in which media is created and consumed. There was probably Twitter in its early days back in 2012, but the nature of media these days has changed so vastly. We're kind of consuming it 24/7. There's a whole bunch of new business models that are set up to try to make money off the delivery of this news. Long form journalism is said to be under some form of attack. My question here, Robin, is to get you to reflect on, let's say, the last 10 years in terms of the evolution of what it means to be in journalism. What's different? What's harder? What's more interesting? Tell us just a little bit about how things have changed over the past decade.
There's a lot
in 10 words
changed,
only.
I think. With well, that's, I think, probably a challenge beyond me. But I mean, everything has changed. The FT, frankly, before I joined, had already pivoted extremely strongly and successfully eventually to being a digital newspaper. I haven't gotten the physical paper for many a year now. And I go to the conference because I represent my team. They're the morning conference with all the senior editors. And the newspaper, the physical Financial Times, is, I'd say, an afterthought. It's still a very valuable afterthought. It's huge for our brand. We still make lots of money. Print advertising still makes money for us. But we are a digital news organization. And that had started. So that has accelerated and gone further and been more successful than I dared hope. But that was, at least, you could see the contours of that when I joined the FT. And even before that, I remember when I was studying some journalism and somebody gave us a class in this hot new research tool called Google. I literally had a class in how to use Google. I was reasonably internet savvy, so I knew a little bit about it, of course. Since then, social media is the big thing, I think, beyond the just digitization of everything. I joined Twitter first with the Green Revolution, or the aborted Green Revolution in Iran. It was a great way of following what was going on in the ground there. But I didn't really use it as much. A little bit during the Arab Spring. It was good to kind of get stories out there, but I was a very passive user. The eurozone crisis was when you first noticed that quite a lot of serious and unserious finance professionals had migrated on and had anonymous accounts there. So it went from being somewhere where you just kind of broadcast your stories to being quite valuable to both learn and to source build, and frankly, to be accountable for what you write. I'm a big believer that journalism is best when it's quite heavily criticized. I always tell people, like, when I write something dumb, tell me, because then I hopefully won't make that dumb mistake again. But quite often there's this sort of a politeness. Nobody likes criticism, but there's a way to do it well. And I think, broadly speaking, journalists can be probably a little bit too sensitive. And I think, yeah, social media has changed that a little bit. And some people don't like that aspect of it. And I'm a dude, so I get a better social media experience than the other half of the world's population. But broadly speaking, I think it actually has helped make us a little bit more accountable. At least for me personally, I've met lots of great sources through Twitter.
I was just going to say, maybe one example of the changes that have occurred in the production of media is FT Alphaville as an example. That's not something the FT would have considered 20-something years ago. Tell us a little bit about FT Alphaville's product and some of what you guys are working on these days.
Oh, God, yeah, my favorite topic, really. I'm kind of an Alphaville fanboy, first of all, and an editor of it. Secondly, I've only been the editor of Alphaville for a month or two now, I think. No, so it started in 2006 when, yes, it was considered kind of zany by an old traditional newspaper like the FT to set up a weblog, as some people still called it at the time, or a blog. But this was part of the FT's digital transformation. We had a very prescient editor called Paul Murphy, who convinced the editor at the time, Lionel Barber, and the owner of the FT at the time, Pearson, to back him with some money. So he went out and hired a bunch of young, bright journalists who didn't have tons of experience, all of them, but they were really smart people, and kind of let them enjoy the freedom that a blog has to do stuff that cannot be done in a traditional journalistic format. My main complaint sometimes about journalism, and quite often the main complaints I see other people have about journalism and journalists, is that sometimes substance gets shoehorned into a form. The structure of a news story or a profile or a feature, there are reasons why these structures exist. They're usually quite good. They're there for a reason, but sometimes they can be very constraining and actually lead to suboptimal content, to use that ugly word. With Alphaville, I don't have to think about what is a classic FT story. I can think of what is the best way to give this information, this analysis, this news to people, whether it's through traditional story, sometimes that works well, or literally just like a bunch of memes or GIFs. And that's been great fun. And some of the people that have worked on Alphaville over the years are just insanely talented. But essentially, it has changed shape with whoever happens to work there. And there's always been kind of the FT skunk works, or maybe our Bell Labs. Maybe that's a nicer way of saying it, really. And I hope it will continue under my glorious reign.
Let's just comment before we shift to your book on trillions, which I'm eager to discuss with you. Let's just talk a little bit about what you've recently been publishing on FT Alphaville, which is this Terra Luna collapse. I'm sure that's resonated with a lot of people. Tell us about how you and the team got directed to that and started diving into this recent debacle in DeFi.
Well, I mean, full disclosure, I'm a massive crypto skeptic. I try to stay open-minded that eventually, like most sort of insane, stupid bubbles, it'll lead to something valuable like the railways or cable back in the day. But I've yet to see any meaningful innovation outside of essentially making it easier to drag more suckers into that world and to extract more money when they're inside it, extracting rents more efficiently. And I think the Terra Luna thing is a good example of that. That was something that was very flawed from the beginning. I hadn't looked in depth beyond looking at the structure of how it worked with the algorithmic stablecoin system. And you kind of always knew or suspected that at some point something was going to cause it to keel over. And we were well prepared when that happened. It was mostly some of my colleagues writing the best stuff. I just sort of oversaw it and nudged them occasionally in the right direction if that was even needed. But for me, it's not if like a jump trading or a Galaxy loses money. They're big boys. They can deal with it. It's all the other people who were sucked into it by 20% yield farming, as it was called. I just think is intensely problematic. That this is an industry that by design, not by accident, but by design, tries to suck in people who don't know what they're doing. And there are words for those kind of schemes. And I just think it's hugely problematic. And even insiders say there's probably like 70 to 90% scams, and say that as if that's still worth saving. So look, if something had 80 to 90% crime, would we say, yeah, that's completely fine? Yeah, go ahead. It's like 10% honest. That's fine. I don't get it. But as you can tell, I'm very skeptical. So I was not sad to see the demise of the Luna Terra coin algorithmic stablecoin.
It is very sad to see in the aftermath the degree to which the man on the street fell into this. And it does remind me, there's similarities, the almost infinite issuance of Luna to protect Terra. It reminds me of this VIX debacle that occurred in early 2018, which, again, in the aftermath, you realized how many people were long what they thought was a stock with a management company called the XIV. There, it wasn't infinite supply, it was infinite demand for VIX futures to rehedge in a very short time frame that was the demise. But it is unfortunate to see retail get lured in to these types of scenarios. Well, let's do this. Let's spend some time on your book. So full disclosure, I really enjoyed it. Thank you for writing it.
Well, that's good
I
to know.
am a student from the University of Chicago, and so hearing names like Gene Fama really resonated with me. I thought your research here was really painstaking, and that's where I want to begin, which is tell us about the inspiration for the book. Let's start with that. How did you settle on the desire to produce this pretty comprehensive retrospective on the growth of the passive investment industry?
Well, it boils down to when I moved to the US. I mean, I'd covered the index funds and ETFs and how they were having an impact, especially in emerging markets from London. So I was also covering sovereign debt globally by then. But in 2015, I moved to New York to take charge of the US markets team at the FT. And we don't have the number of journalists that the Journal or Bloomberg have. So we have to be more strategic in what we do and how we cover. There's certain things you just have to cover, like the Federal Reserve. We can't just skip a Fed meeting, even though the value add, the incremental value add of writing what the Fed did that day is close to zero. It's a very well covered event. But there are other areas, and you can look for subjects and themes, topics that are either misunderstood or undercovered because they seem boring, but they're actually really interesting or important. And for me, active managers and hedge fund managers, they're big personalities, they're people and narratives. Journalism loves that. Index funds are kind of inherently boring and dull, and by design so. But you could just see by 2015, it was very clear that this was just massive. And it was growing still, despite the size, the growth rate was still hooking upwards. So I just thought this is something I need to, this is a subject I can do a pretty good job of. This is one of the many things I cover, but I want to do this really well. And how this affects both markets and the entire investment industry and knock-on impact on broker-dealers, for example. And I was current for the FT, and then because I'm a bit of a history buff, I started looking into the history of index funds, like who invented the first index fund. And lots of people think it's Jack Bogle, but it really wasn't. And then I discovered that the people, the stories behind the invention of the index fund and its growth and evolution into ETFs and what we now know were just fascinating people. And there was a great narrative there as well. So if you have an important story and an interesting one, I think if you're a journalist, you kind of feel you have to do something about it. So I wrote a magazine piece on the history of the index fund that a book agent loved, got in touch, got me in front of some publishers, and Penguin's imprint portfolio was kind enough to give me a book contract. And that's how it happened.
I think that's the juxtaposition that you said it. And I think that's really what resonated with me, which is, yeah, indexation, it couldn't be as plain vanilla as possible. I'm not saying it's easy to build something to scale, but it's pretty plain vanilla. And yet the way in which you bring to life the early characters in this book is really interesting. So let's talk a little bit about those folks. I mentioned some of the academics, certainly guys like Gene Fama and Rex Sinquefield and so forth. But you go back before then, way before then. So bring to life for us a little bit of maybe some of your favorites. We'll talk a lot about Jack Bogle for sure, but tell us just a little bit about some of the quirky characters you came across and their impact on what's become such a huge thing in investing.
I loved exploring the characters. I mean, I do think journalism can sometimes be too person obsessed, but these people were just fascinating. Even the Terminator has a cameo in the history of index funds. I could have started this in sort of 16th, 17th century Amsterdam, but I had to start somewhere. And for me, one of the least appreciated characters, because he died sort of unknown pretty much, but the guy I considered sort of the godfather of the index fund is Louis Becquelier, a French mathematician who studied mathematics at the Sorbonne in 1900. But he came from a reasonably well-to-do family, but not enormously well-to-do. And his parents had died when he was quite young, so he had to kind of manage the wine business first before he could actually go to study. And whilst he did it, whilst he was a student in Paris, he worked at the Paris Stock Exchange. And that made him interested in finance, even though he was a classical mathematician focused on probabilities. His teacher was Henri Poincaré, who was a famous, and still is a famous mathematician. And he wrote his thesis on how stock prices moved. His tutors thought this was kind of original and interesting, but finance, even today for some people, but certainly in 19th century Paris, was considered a little bit grubby. It wasn't a theme that serious mathematicians should tackle. So he only got a good grade rather than a very good grade that he needed to get tenure. So essentially, he just bounced between various universities. He'd only got tenure shortly before he passed away, and he was pretty much unknown except outside of certain circles, mathematics circles that studied probabilities. But then by chance, an American statistician called Jimmy Savage, who's this huge genius, the true polymath, but he was professor of statistics, I think, in Chicago, discovered Becquerel's thesis, theory of speculation, and was just blown away by it and sent it to an even more influential friend, Paul Samuelson, the big daddy of American economics. And that's how, essentially, Louis Becquerel never used the term random walk, but that is how that started spreading, that concept that stocks seem to take a random walk, and it's very hard to predict. And at any given time, presumably equally informed buyers and sellers both think they're getting a deal. So the market is, and he never used this term either, is efficient. And then people like Gene Farmer and others, Paul Kuttner, built on that. And that became the efficient markets theory that underpinned the first generation of index funds.
Yeah, it was probably by the late 60s into the 70s, there was this entire aspect of academic finance, empirical finance, that was essentially focused on testing. And you would test this hypothesis and see if there is information content that's left on the table such that you can systematically outperform the market. A lot of people didn't want to hear that. And I think you referenced, I want to say it was a 6,000 word ad put out by Merrill Lynch in the, the Thundering Herd. Yeah. Walk us through the early days of indexation and passive investing. It wasn't really a promising beginning in a lot of ways. I'd love for you to talk to me about the Battery March Dubious Achievement Award. I thought that was quite excellent.
Some academics have started studying some of these things, but frankly, didn't have computers. So Harry Markowitz, another sort of big character in the book, he'd coined the idea of like efficient frontiers and diversification and things like that. But literally computers that could do the calculations, calculate the covariances, didn't exist at the time. Or the only computers that really existed were kind of in Los Alamos and working on nuclear weapons design. So it was actually the dawn of the kind of more available computing that made some of the theories or ideas testable. But for me, one of the real some foundational moments was when, like you say, Merrill Lynch basically funded a massive study of the US stock market. And they did it because they wanted to sell stocks to ordinary Americans in the 60s. And they were going to take out an ad, this big page ad saying, here's everything you need to know about stocks. You should buy them. They're a great savings tool for the ordinary American. And the SEC, as insane as it sounds today, actually vetoed that because they said, we don't know if stocks are a good long-term investment. You have to prove that, because this was a generation scarred. People still remembered, many people still remembered the Great Depression. Many people thought bonds were the better asset class, the higher returning and safer asset class. And stocks was kind of a bit for spivs, as they say in the UK. So Merrill Lynch went to the University of Chicago's Jim Lorry, who's a professor there, and gave him a big sack of money, a metaphorical sack of money, and said, study what the long-term returns of the US stock market is. And because nobody actually knew that, he worked together with a colleague called Larry Fisher and painstakingly manually collected all the entries from old Wall Street journals and Barron's and various regional newspapers and cross-checked it and put it on a magnetic spool. Because some of this stuff, some things that were called a stock was not actually a stock. It was actually a fixed income security that they gave any ownership rights. And other things that were just called bonds were actually stocks, but were mislabeled because bonds were easier to sell. So they had to check all these things, dividend payments and stuff like that. So it took them years and years. But by 64, they finally had the results. And they showed, lo and behold, exactly what Merrill wanted, that the US stock market had been a phenomenal investment in the long run. And even if you'd invested in the peak just before the great crash of 29, you still would have made out like a bandit. So Merrill Lynch took all these results and printed in these 6,000 word ads that you mentioned in newspapers across the entire country. What Merrill didn't mention, but certainly lots of academics became very aware of, and a certain segment of professional investors, was that the long-term returns of the US stock markets was quite a bit higher than the average return of US mutual funds and investment trusts and pension plans and insurers. This is pre-internet. That information didn't really filter through. So it took kind of the first generation of kind of iconoclastic finance industry insiders who both read the research and realized what it meant to change things around.
Let's talk about Bogle. You reference in the book that he used the famous Keynes quote, "When the facts change, I change my mind. What do you do?" Was he initially a skeptic around passive investing? Did he think that there was alpha to be had in active management, and then upon a closer inspection decided he didn't view it that way?
The dirty secret about Jack Bogle is that he always believed there was alpha out there, but with some big asterisks attached. But initially, he detested the idea of index funds. So one of the first mentions I ever came across of, it wasn't called an index fund, but it was a market portfolio. In 1960, a Californian economics professor suggested this in a paper called Edward Renshaw that said, hey, there's so many funds out there. It's very hard to choose between them. Somebody should just start a market fund and sell that as a cheap, keep your money parked here until you find an asset manager that you like. So he did it in a kind of very circumspect way. And he never talked about indices or anything like that or market efficiency. It was a utilitarian argument for something like this. And Jack Bogle was then senior vice president at Wellington, big active group. He, under a pseudonym, wrote a paper basically rubbishing Edward Renshaw, saying this is preposterous because everybody knows that major mutual fund companies outperform the benchmarks in the long run. And he, with this old slide ruler, showed exactly how you could come to that conclusion, which again shows that if you torture data long enough, it can show you whatever you want. He only became an index fund convert in 76 after being sacked by Wellington and had set up basically a company owned by the Wellington funds called Vanguard. And the divorce agreement with Wellington, the management company, meant that Vanguard couldn't do any management. So he argued to the board that an index fund was unmanaged and therefore did not breach the agreement with Wellington, that Vanguard could do no investment management services. Amazingly, the board agreed. And that's why he did that first index fund, which became the Vanguard 500. Not because he was a huge believer in it, though he was always a believer in cheap fees. That is definitely true. I've gone through a lot of his old writings, and he was definitely always thought that the investment industry overcharged. But he was only really the passive zealot that we know by the 80s and arguably maybe even 90s when it really started taking off. And he decided that he would become the grand proselytizer for passive investing.
It's such an interesting backstory in terms of the split off from Wellington that you describe in such detail. So that was 76. And what did the next decade look like for passive and for Vanguard? What was the progress made, let's say, over the next 10 years?
Well, so the first three index funds were started by Battery March and American National Bank of Chicago and Wells Fargo. And initially, they were just aimed at pension plans. Wells Fargo tried to do something more retail, but because of Glass-Steagall, they weren't allowed to. So they all, frankly, shared their data with Jack Bogle and Vanguard when they were setting up their own index fund because they weren't rivals. Nobody wanted to do anything for retail because, frankly, people are worried about cannibalizing their own business. And the Vanguard 500 fund was just an abysmal failure. They were hoping to raise over $100 million for the initial IPO of it, as it were. And they only raised $11 million. So it was an abject failure. And even on the institutional side, there were lots of big pension plans, especially the baby bells, that could see from their own internal data how bad a job their mutual funds were doing. So they were the first that really adopted index funds. And one thing I almost wish I'd bigged up more in my book is the positive role played by the AT&T pension plan systems, the baby bells, in supporting various index funds, because they funded a lot of different ones on purpose, it seems, because they wanted that rivalry. They wanted Wells Fargo to compete against American National Bank of Chicago and Battery March and State Street eventually. And Bankers Trust was also big in this. But by the 80s, it was still primarily an institutional thing, and it was slow to take off in retail. It's only really in the 90s things really started to change, and especially in the 2000s, because nothing makes people more cost conscious than the bear market. And active managers have a great story to tell that we'll prove out, maybe we lag a little bit in the bull run because these index funds are very top heavy and all that, but we'll prove our worth in the next bear market. But lo and behold, every single bear market since the 70s, active management has performed abjectly on average. They've actually underperformed. And that's why you've seen the shift into passive broaden and accelerate after every single major market correction since the 70s when the index funds were born.
You spend some time in the book talking about the founding of BlackRock and Larry Fink and his business partners, and the coming together with Merrill Lynch Investment Management, with BGI. Tell us a little bit about that part of your research process and what you learned about the kind of early days of BlackRock, and then how it got to manage the tidy sum of, I think, 9 trillion.
Yeah, 10 trillion now.
10,
I think,
sorry.
Probably gone below 10, given how markets have moved this year. BlackRock obviously didn't start off as a passive player. So it enters my story quite late on with the acquisition of Barclays Global Investors. And Barclays Global Investors is the successor body to Wells Fargo. So essentially, Wells Fargo set up a firm called Wells Fargo Investment Advisors, WFIA, to house all the kind of the zany research they were doing, including index funds, and eventually sold that to Barclays. And there it became one of the world's, if not the world's biggest asset manager, powered primarily by passive funds, but also active quant strategies as well. Barclays, this was the crown jewel. They knew it. They knew they had something very valuable. The profit margins at BGI were just insane by 2007, 2008. But obviously, as you know, Barclays had a very bad financial crisis, especially after buying the US parts of Lehman Brothers. And it was desperate to avoid a UK government bailout because of the impact it would have on bonuses. So they sold the family silver to BlackRock. I think the reason why BlackRock plays a fairly big role in the last parts of my book, and why I think they're just such a fascinating company, is that Larry Fink, people have different views on him, but I do think in the investment industry, he has a better strategic mind than pretty much anybody. That he has seen how a lot of trends would be before others have. And he saw that ETFs especially, but index funds in general, index funds were already big by sort of 2009, but ETFs was the kind of the next gen version. This was still well south of $1 trillion at that point, but he thought it was going to become a huge thing. So they paid what lots of people thought was an insane price right after a financial crisis for BGI. They made it work, and that's why iShares is now, I think, close to 3-4 trillion by itself. There's another 3 trillion plus in other index strategies at BlackRock, and that's like the vast preponderance of assets, and why my argument is that Larry Fink is the most powerful person in global finance today, thanks to that acquisition and the influence that the shareholder ownership or management that BlackRock has through index funds.
That's where I wanted to finish our conversation, because you not only run through the history of passive investing and really bring to life some of the consequential players in the development, but then you spent some time in the end reflecting, which I really liked. And I took some notes here, and I wanted you to reflect on your own reflections. So what I wrote down, just in terms of the kind of risks and considerations for passive investing. The first is just that there's a proliferation of ETFs, some of which are buyer beware. The 2 times levered inverse, tracking error, there's all kinds of next generation ETFs that don't exactly fulfill some of their promises. So that's one, but we kind of know that. You talk about Mike Green and some of his work on the risks of indexation. So maybe we can talk a little bit about that. And then you've got a couple other things here that I'll just put in one category, but I found them so interesting. You talk about the oligopoly risk of just having a couple of providers. There's BlackRock, there's State Street, maybe one or two others. It's a very small community of firms that has a tremendous amount of assets under management. And then almost even more interesting, you reference the power of the index providers. So Standard & Poor's. And then lastly, I wanted you to also comment on, I also found this really interesting, the power of the proxy vote companies, ISS being one of them. So I know I threw a lot out there, but maybe just kind of take them in turn, just the types of things after you were done with your work and you had time to reflect on it, the things that were top of mind, because I think you're a big fan of the product. I think you certainly look at it and say, wow, this has definitely been a force for good, but nothing's perfect. So tell us what's on your mind just in terms of the risks and considerations.
I think it's very important for even people like me who are fans. And I frankly think any sensible person should be a fan given the cost savings that is brought and pressures on investment fees for everybody, even if you don't use an index fund. But I think it's particularly important for the fanboys like me to be open and not be blind to potential downsides. I see the index fund as a new technology, and not that new anymore, but a very disruptive technology. And it's now so big that it almost has to have an impact. And I think you need to be aware of where that could be. And I mean, on the proliferation, maybe in order of what I'm worried about is, first of all, is the proliferation of funds, especially of ETFs. I mean, some of that stuff is just stupid. I mean, you know this well, and you mentioned like February 2018, the blow up of XIV is a perfect case of not just retail investors getting hammered on something they didn't understand, but it's having a macro impact on markets. I think this is my general view of many of the levered and funky ETFs, is that they're at best dangerous to the financial health of the individual buying them. At worst, they're a potential danger for markets as a whole. I don't like them, and I think it's dumb, but we've seen this many times through history. Humans are great at taking a great idea and just overdoing it. Like securitization, an amazing idea that has genuinely made the world better, but then 2008 happened and you end up starring in The Big Short and a Michael Lewis book. We take things too far, and I think that is what's happening in some of these areas. The second one is like the Mike Green arguments. And Mike Green is, I think, one of the more erudite and cerebral critics of index funds. I read a lot of criticism of index funds going back 50 years, and it is astonishing how idiotic some of it is and how little it has changed. Like, the arguments are really asinine. But I think more recently, and frankly, a lot of the stuff that I still on an everyday basis here is still fairly facile stuff. But there are new critics and interesting people that are coming out and making more complex and reasoned arguments that some I agree on. I just don't think they're a big deal, and some I disagree on, but smart people can disagree on these things. I think that's kind of interesting. And I read a lot of this research quite religiously, whether it's like a Mike Green, like Paul Singer at Elliott has actually written some really interesting stuff as well. Kujan, I mean, if you look at some of the academic work, with the caveat that academics, you don't get published in prestigious journals by saying, oh, I spent 2 years studying this problem and there's nothing really interesting to say. You have an incentive, just as in journalism, to be a little bit sensational. But there is interesting research happening on to what extent do index funds and passive investing have an impact on markets. My view is that it tends to be more on the micro level than the macro level, in that I can see very clearly in certain cases, individual stocks and sectors, there are big factor moves, individual stock moves that have to do with index fund rebalancing and stuff like that, that it is definitely having a footprint on markets. I just struggle to see any real tangible evidence, plausible evidence, that is impacting the efficiency of markets as a whole. In fact, I think by basically being a cheap alternative to mediocre and underperforming asset managers, it is helping making the market better, because it's getting harder and harder every year to be an active manager. You have to run faster and longer than ever before. So I think the active managers we have today are quite possibly the smartest and hardest working active managers we have ever had. And that is what's making markets better. It's the decline of retail trading. It comes up and down with fits and starts, but passive investing has helped make that market more efficient by driving out mediocre managers that made markets less efficient. On the third one, I think it's an unsexy worry, but the index providers themselves, the people like MSCI, S&P Dow Jones indices, and FTSE Russell, they are utterly dominant. They control around 80% of all the assets, or the index kind of assets that track their indices. And I think their influence, I don't think it's bad. And I think they, to be fair, try to do a good job and take their power seriously. But I think they have amassed on the sly or on the quiet side so much power and so much influence that I think that needs to be tackled somehow. I just don't know how, because it's one of those problems that there are no good answers. There's lots of suboptimal solutions, like making them fiduciaries. Like that might help some of the responsibility, make them more closely regulated, but that again might be just form over substance. It doesn't really address the problem. And the one I think is the least tangible concern is the last one you talked about, just how big the index fund giants have become and how inevitably they are going to become bigger given the economics of indexing. The economies of scale involved there are just so huge that BlackRock and Vanguard especially are just going to become even more titanic and dominant than they are today. And again, generally speaking, I think they've been good stewards of that money and they try to do the right thing, though there are always going to be people on the right or left that disagree on the various policies. But just as a matter of principle, I don't feel comfortable with the idea that, in theory, within the next generation, half of all the shares of every major listed company in the US and probably the world is going to be controlled by just 2 or 3 or 4 big indexing companies. I don't think that would be helpful, and I can see many ways that would go very bad. It was a concern that even Jack Bogle admitted he was very worried about before he passed away.
Yeah, it's interesting. If you mentioned the terminal, I spend quite a bit of time on the Bloomberg terminal myself, and if you hit up the HDS page, the holders page, invariably the top 3, you know in advance who owns these stocks in giant size, and lo and behold, none of those investors are reading the newspaper. They just own them. That's just passive investing, which I think is really interesting in light of some of the, I'll use the word bubbles. I know people argue over the word, but it would be hard to argue that the NASDAQ in 1999 and 2000 wasn't in some valuation bubble. And so if you were buying the triple Q, which is just the index of what's in the NASDAQ, you were buying stocks at a 200 PE. Or if you're following the Barclays Ag in and around 2017 or 18, you're buying debt at the lowest nominal yields in centuries, some of which are negative nominal yields, but you're a passive tracker. It sometimes gets capital directed into, I don't know, strange pricing environments, I guess is how I'll put it.
Well, I don't see, this is one of the sort of the market efficiency issues that I think index funds, they are just a tool through which we as humans and consumers and savers exert our will on markets, as it were. And I think a lot of the stuff that people blame index funds for is essentially better placed at the feet of interest rates falling for 40 years, which I still think is an underappreciated force that has shaped everything in finance for the past generation plus. And just human nature, that people are buying the stock market a lot now, and they are increasingly doing it through index funds. And when people buy the stock market a lot or put lots of money in stocks because they think the stocks are going to go higher, it pushes prices up and eventually bubbles form. But it's just the tool that we are inflating the bubble with. And blaming the tool for what we do just seems stupid. And that there were many, many, many bubbles, including technology bubbles, long before the index fund was invented. I mean, the index fund kind of grew out of the ashes of the go-go era. I always think of that as the first dot-com era. It wasn't like Amazon or Tesla or anything like that. It was Kodak and IBM and Xerox were the hot tech stocks of the 60s. And they had their own active management stars, people like Fred Alger and Jerry Tsai. And they all crashed and burned when the go-go era ended. And that's why the index fund was invented or grew out of that detritus. But yeah, we will inflate more bubbles in the future, inevitably. But I just think we should be wary of blaming the tools through which we do it rather than ourselves, as it were. Should we blame mutual funds for inflating the bubbles of the 60s, 90s, and mid 2000s? I'm not sure about that either.
No, I totally agree. I'm not suggesting that the funds are responsible for what, again, in hindsight, it's very easy to do anything in hindsight. We started our conversation talking about the financial crisis, and there were a lot of people jumping up and down. I'm just recalling just lots of blogs back then about the impending housing crash. But if you were a year early, you were rendered irrelevant, and Cassandra for trying to alert people. None of this stuff is easy. One of the other things that just comes to light through your work is that these are really technology companies, and the incredible focus on technology and scale has led to so much cost reduction. I mean, it is a remarkable product to effectively deliver for free and yet still have a way of enriching the shareholders and the folks that work there. I think that's just an incredible statement about how much these companies lean into technology.
I think it's important to remember, and this makes me very unpopular on Reddit or Twitter sometimes, but I actually think this is a golden era for especially the American investor. I mean, you hear about it a lot. You hear a lot about how everything's terrible, the market is rigged, and everything's awful. But trading costs have never been lower. Investment costs have never been lower, whether you do it actively or passively. Even hedge fund fees are coming down. And that is, to a large extent, thanks to technology. And sometimes, as we kind of get worked up about the subject of the day, I think it's important to step back and appreciate that. The index fund is a big part of that. I feel an underappreciated part. And that's why I spent a couple of years writing an entire book about it. But broadly speaking, technology has changed so much in finance that some people don't even realize. I was talking to some colleagues about this, and they thought I was joking when I was talking about floppy disks. They thought, like, are you pulling my leg? Floppy disks? Maybe in the future we say, for like fixed income trading, it will never change. It'll always be kind of hand-to-hand combat between dealers and clients. But actually now, again, I'm looking at research showing the growth of portfolio trading, electronification of fixed income markets. A lot of stuff that we thought would never happen has happened. And again, frankly, the ETF has unlocked a lot of cool stuff going on in fixed income now. I think the fixed income revolution, or the ETF revolution, or the index revolution is not finished yet. I'll still have some chapters to write in the next edition of my book, I hope.
I think the sequel called Quadrillions may be in the offing at some point. Well, Robin, it's been great to chat with you about your work and learn a little bit more about you as a financial journalist and about your deep dive here into this behemoth called passive indexation. So I want to thank you so much for being a guest on our podcast.
No, thanks, Dean. I really appreciate the invitation.
You've been listening to the Alpha Exchange. If you've enjoyed the show, please do tell a friend. And before we leave, I wanted to invite you to drop us some feedback, as we aim to utilize these conversations to contribute to the investment community's understanding of risk. Your input is valuable and provides direction on where we should focus. Please email us at feedback@alphaexchangepodcast.com. Thanks again, and catch you next time.